About 2/3 of a percentage point higher, 11,160 and counting higher.
The market is picking up pace and it's looking good and green.
It's just about holding on to the green with slim gains. So we're up close to about 0.2% on the benchmark indices.
All the key indices are positive, but the Nifty is just about barely holding on to the green, at least as of now. Mid-caps fare better.
Well, it's been a decent day of trade. Yes, we went to around that 11,200 odd mark, and from there, we did see some profit booking.
Well, markets failed to hold opening gains and absolutely flat. Mid-caps and small caps outperformed, gain between 0.5% and 1% each. Metals and auto stocks shine.
Metal stocks see handsome gains on improved demand from China. Nifty metal rallies 4%. Hindalco, Tata Steel gained the most.
Axis Bank gains over 1% after it sees strong demand for its 10,000 crore rupee QIP, while Info Edge hits new record highs post its 1,875 crore rupee QIP gets subscribed by 4 times.
HDFC ends mildly lower after sources say it plans to raise 14,000 crores in a single tranche of equities and warrants.
Strides Pharma rallies 14% on strong first quarter numbers, while Cadila loses 2% on revenues which were below expectations. Godrej Properties stumbles on a weak first quarter set. Well, those were the top 5 headlines from Dalal Street. Hello and welcome to a fresh new edition of Markets Today, the show where we tell you what happened in those 6 hours of trading. We'll get you all of the action in the market. I'm Prashant, with me, my colleague Sonia Shenoy. Hi, Sonia.
Hi Prashant, what a day, right? Of course, we're going to talk about all the sell-offs that we saw, especially in some of the large cap names, but that happens in the next half an hour. Here's what you'll see on the show in the next half hour. Market opinion from JP Morgan's James Sullivan and Amish Shah, the India equity strategist at Bank of America Securities. Banking analyst at Macquarie Capital Securities, Suresh Ganpati, also will join in with his expert opinion on the financial sector. But before all of that, Prashant, today was one of those days when, you just could sense that there was a wave of profit taking. A lot of the large caps came under pressure. But what did you make of it?
Sonia, Monday there was a sharp sell-off. There was no follow-through. I mean, basically, Monday the Nifty sold off 180 points. Tuesday the market went up 200 points. So it recovered the 180 point cut, and then it went up some more. And today we've got the close we've got, which is basically it was cruising along nicely over 100 points higher, and by close it was flat. I mean, there is no trend. I mean, at least in the very near term, the last couple of days, it looks like there has been some momentum loss, which we have definitely seen. Is this just a precursor right before the RBI policy? When we'll have to wait and watch, but there wasn't any particular indication of that just looking at the financials. I mean, actually, the financials pack was one of the stronger parts of the market today. Metals, of course, were right up there. The metal index is breaking out clearly. I mean, specifically names like Tata Steel, Hindalco, even some of the smaller names like SAIL, Nalco, etc. There is momentum which is building in. The street has been very focused on steel and the steel price hikes, but there is more. Nigel will join us later to talk about that. Small cap and mid cap part of the market, there is no problem there. Market breadth as a result of the gains in that part did quite well. Advances to declines ratio good. Lots of fundraising activity. We've had we'll have HDFC, we've had Axis, we've had Info Edge, we will see ICICI Bank later in the week or maybe next week. IndusInd Bank, for example, RBL. And there is capital which is available, which is a good thing. So, we'll continue to track that. All eyes on what RBI does tomorrow. And I think, depending on whether the RBI sort of decides not to extend the moratorium, does it actually go in for a one-time restructuring? I think those will be important. Just the way the market reacts to it. If, for example, a one-time restructuring is given, is the market going to be pleased with it? Or will it say, well, this is just kicking the can down the road. We will not know much of the pain till sometime next year. So, I mean, the reaction is going to be interesting. Globally, the dollar index has continued its weakness. We came into this week with this apprehension that the dollar is pulling back, but the gains on the DXY stopped at about 94. And we are lower now. And of course, I mean, precious metals continue the move. The gold has passed the $2,000 mark. Silver, I mean, it's not really participating that much, but gold is the one to watch. And of course, I mean, S&P 500 futures are trading above the 3,300 mark. NASDAQ is above 11,000. I mean, futures have been strong and the global risk on sentiment has not gone anywhere. But let's talk about stocks, Sonia. What happened?
Well, you know, today the big move really came in the metal space, as you rightly mentioned, Prashant. So it was Hindalco, Tata Steel that were the top Nifty gainers on the back of improved China data. Apart from that, autos continue to move higher. In fact, they've been surging ever since the July data for auto sales came through. Tata Motors, Eicher were both up 4 to 5%. Axis Bank had a very strong demand for that 10,000 crore QIP, and that helped the company gain over 1% in trade today. In some smaller stocks, Info Edge hit a record high after the company launched its 1,875 crore QIP. Cadila Health slipped, but it had a very good set of numbers, and the stock has had a fabulous run over the last many weeks and months. SAIL was one of the metal stocks that did very well. It was up almost 6% after reporting improved volumes in July month-on-month versus June. Reliance Industries, in fact, from the heavyweight, slipped about 3% from its highs to end 1% lower, and that really dragged the Nifty by about 18 to 20 odd points. But by the end, it was not all lost for the bulls. The market breadth favored the advances. The advance decline ratio still ended at 2:1 in favor of the advances. So you can safely say that yes, there was some bit of profit taking in large cap names, but overall the breadth of the market was still intact. But we are underweight on India. That's not me. That's the word coming in from James Sullivan, the Managing Director Asia for Equity Research at JP Morgan. We spoke to him earlier in the day, and he said that market valuations in India make the investments in this space very challenging. So let's listen in.
We are actually underweight India right now. And let me explain some of the underlying rationale behind that call. We really think the most critical thing for investors to be focused on is this concept of lost growth. One of the biggest things that we saw as an impact from the global financial crisis in 2008 was a change in the growth rate of the global economy and a downshifting of the global economy. We're seeing the same type of impact off the COVID crisis. On a global basis, JP Morgan is forecasting 4 percentage points of lost growth at the end of 2021. So this is not just a short-term conversation. So again, the global number is 4%. The lost growth for a market like China would be only 70 basis points. For India, that number is 9.8%. And so we do see a significantly shallower slope of growth for the Indian economy moving forward, which makes the valuations that we're looking at in the market somewhat challenging. This idea that India is perhaps best placed in the world right now to take share of global manufacturing, to take share of supply chain diversification. We're not really focused on aggressive supply chain relocation. If you look at surveys of corporates, particularly in markets like China, you are not seeing large numbers of corporates that are looking to shut down facilities in China and move them offshore. However, what we do very clearly see are many multinationals around the world looking to diversify their supply chains, looking to reduce single country risk. And India is incredibly well placed to take advantage of that phenomenon.
Okay, that is JP Morgan's James Sullivan weighing in. To the second headline then. Metal stocks shown in trade as the index rallied 4% on improved demand from China. And of course, the dollar weakening has helped along the way as well. Hindalco, Tata Steel, Steel Authority of India led from the front as these stocks soared anything between 6 and 9%. Nigel is here with the action. Nigel.
Well, metal stocks were on fire in today's trading session. A few factors that played out. There's a gush of liquidity. Chinese demand and Chinese data points are improving. And also a weaker dollar is very, very good for the non-ferrous companies because base metal prices do move up. We have Credit Suisse. They came out with a note on steel players and they highlighted a couple of very, very interesting facts. One, they say that, in fact, in terms of price increases, towards the end of July, we had price increases in the domestic market to the tune of around $10. That was followed by another $27 per ton price increase, which is positive. But they also go on to note that the export prices have moved up by nearly around $40 per ton. So yes, domestic prices are moving higher, but in the export market, prices are moving higher at a faster pace. Put these data points together, they say that even after the price increases that we've seen in the domestic market, the domestic steel prices are nearly around a 10% discount in comparison to Chinese landed steel. So that's giving them a further headroom to go ahead and increase prices. Steel prices are moving higher. They highlight that raw material costs for Indian producers are not going up by that fast a pace, which is good news for steel spreads. And they say that steel spreads are at the highest they've seen in the last 15 months. That explains why steel stocks moved higher. We also had some data coming out from SAIL. They said that in the month of July, the production numbers were much higher on a month-on-month basis by nearly around 24%. And on a year-to-year basis, it's nearly by around 50% approximately. Remember, it's coming on a low base, but those numbers look good. Though Morgan Stanley, they continue to maintain their underweight rating on SAIL.
All right, then, Nigel, thanks a lot for that. Let's move on to the third headline for today. Axis Bank gained over 1%, like I told you guys earlier, on the back of strong demand for the bank's 10,000 crore QIP. Nimesh is here to give us more details on all of that. Nimesh.
Hi, Sonia. So, Axis Bank closed the QIP book today morning. There was a very strong demand, is what I understand from bankers. Almost 3-time book was covered. And within that, 80% of the demand came from long-only funds. So pretty strong response to the Axis Bank QIP. They've closed the book and will be raising 10,000 crores by issuing shares to the institutional investors.
Nimish, stay with us, because we want to come back and talk about HDFC as well. But let's talk about what has already happened. So Axis has happened. The other one, which in terms of fundraising, which has already happened, is InfoEdge. The stock soared 5% to hit 52-week highs. I mean, fresh 52-week highs. It's already a strong outperformer. 3,353 at close. The company successfully closed its 1,875 crore rupee QIP, which recorded demand of some 4 times of as compared to what was on offer. My colleague Rima is here with the details. Rima.
Thanks so much for that. Yes, what we have picked up from our sources is that InfoEdge has successfully completed its QIP of 1875 crore, which is about $250 million. The demand was very strong. In fact, close to about 4 times, more than 4 times of what was on offer. And roughly, it was priced at close to about a 3% discount to where the stock closed yesterday. So within the band that they had given. Now, remember, the stock has been a big outperformer. It's rallied more than 30% since the start of the year. In fact, with the up move that you're seeing today, the stock has gained, the stock is at a fresh 52-week high. Now, this fundraising is actually pretty interesting because the company, remember, is already sitting on cash. The cash as of the March quarter was close to $200 million, and over and above that, now they've raised $250 million. And if you could get that quote up from the management in the Q4 conference call, they had indicated that in every crisis there emerges an opportunities, and there would always, perhaps there could be an M&A opportunity which would emerge. So that would be the next thing on our anvil now that the company has successfully completed its QIP, which was launched yesterday, and they've raised $250 million. Back to you.
All right, Rima, thanks a lot for that. Well, on to a CNBC-TV18 exclusive now. We learned that Max Financial's Analyse Singh has 2.2% stake in the company via a block deal. Today, he got 2.2% stake via block deal. Nimesh Shah is here to tell us more details on that. Nimesh.
Hi, Sonia. So, again, in Max Financials, the promoter, Alanjit Singh, sold today 60 lakh shares to institutional investors via block deal. That works out to close to 2.2% of the company's equity. He has raised close to 326 crores via stake sale. Now, what I understand is essentially the large portion of this fundraising will be used to release the pledge shares. If you look at the latest shareholding pattern, promoters hold close to 28.3%, but within that, 91.5% is pledged with the lenders. So that was a key concern on the minds of the investors. And that's what the company had promised in the earlier call as well. And they confirmed to us as well that, yes, the promoters have sold a minor stake in Max Financials today. This is another step towards, earlier stated intent of reducing the pledge shares, and they have done this. So it's a confirmation from the group that promoters indeed have sold 2.2% stake and have raised 325 crores to release some pledge shares.
Nimish, thanks very much for that. Well, there is more fundraising to come and enough and more is happening. HDFC, as I promised, but just in a bit, because we want to sort of let you hear out what Macquarie's Suresh Ganpati had to say about the banking sector in terms of the recovery that he sees going forward. He basically says that the banking sector, stocks rather, will underperform in FY21 relative to other parts of the market. Within banking, of course, he likes a bunch of names. Listen in.
The banking sector is underperforming. Also note that the banking sector will be relatively a laggard when it comes to recovery, because some of the consumption-related sectors will recover faster, but the bank balance sheets will remain damaged for an extended period of time. we don't want clearly a blanket restructuring, because the prior experience has been terrible for the banking system, or for that matter from a Reserve Bank of India standpoint. Almost 50 to 80% of the restructured assets went bad in the previous cycle. So you just know how much misuse and abuse of the entire system was being done by the banking system. So if at all restructuring is announced, it has to be selective very clearly, and it has to accompany with a large upfront provision so that the bank balance sheets are protected.
All right, we'll slip into a short break on that note, but stay tuned. Lots more action coming up on the other side. Major HDFC may launch a mega QIP to raise 14,000 crores today. So it's pouring fundraising for companies. Nimesh is back with us to tell us more about this fundraising plan. Nimesh.
Yes, Sonia. So as you said, HDFC Limited is likely to launch a QIP. So the 14,000 crore is the total equity fundraising that HDFC Limited is going to do. Within that 14,000 crores, the sense that I'm getting is close to 9,000 crores will be raised by QIP, and the remaining 5,000 crores will be raised via warrants. So that one is to factor into. Apart from the equity fundraising, there is also going to be a debt fundraising of close to 5,000 to 6,000 crores, and that's going to be via NCD. Now, coming to the equity part of it, as I said, close to 9,000 crores, 10,000 crores will be via QIP, and there will be a warrant component as well. As far as the warrants go, I'm told the conversion premium of the warrants is going to be 22%. The warrant price is going to be 10% of the current price, and there will be a lock-in of 3 years for all the warrant shareholders who participate in the warrants. So that's the warrant part of it. If you look at the QIP portion, which I'm told is going to be close to 9,000 crores, the SEBI formula for pricing of QIP is going to be around 1840 or 1845 rupees per share. So if you add a 5% discount, which is usually the case with QIPs, that will work out to close to 1746 rupees per share is going to be the QIP price. So as I said, that's going to be the contours of the total fundraising. 14,000 crores of equity side split into QIP and warrants, as well as there is going to be a 5,000 to 6,000 crores of fundraising via NCDs. That's going to be a combination. So put together, it's going to be close to 20,000 crores of fundraising is what HDFC is likely to do. And most likely the QIP is going to get launched today evening.
Okay, so fundraising and more fundraising. Nimesh, thank you very much for weighing in on a bunch of things today. Appreciate it. We'll watch when that issue does open, and of course we'll get you details of how the progress on that one in terms of subscription, like we did earlier for Access today. The fifth and the last headline today, then a whole host of companies came out with their first quarter numbers. Mid-caps really, but huge price performance. Strides Pharma, take for instance, and also PI Industries fared well. Cadila and Godrej Properties tanked on weak numbers. Let's get a quick wrap out of all these numbers. The standout, of course, was Strides, wasn't it, Sonal?
Well, yes, whole host of earnings today. Let me start with the good ones. Strides Pharma, strong set of numbers. Revenues increased by 14%. Profits came in at 100 crores versus 25 crores on a YOY basis. There was growth across market segments. For instance, the emerging markets reported 47% growth on a sequential basis. Other regulated markets saw growth of 53%. Let me move on to Cadila, where the numbers were better than estimated. Revenue growth of 4%. EBITDA was up 24% at 815 crores versus a pool of 755 crores. It was also a beat on the profitability. Profits increased 43%, and it was again a beat across geographies. So US posted sales growth of 19% on a YOY basis, which was higher than the street estimate. Also, the rest of the world market saw a growth of around 8%. Godrej Properties, while the reported numbers were impacted because a lot of revenue recognition could not happen because of COVID, the bookings and the sales volumes amount really surged on a YOY basis between 70 to 80%. It was a decline on a sequential basis. However, in its commentary, the management said that they expect weakness in cash flow position this year because of COVID, and also the net debt of the company has increased to 1,700 crores versus 1,100 crores on a quarter-on-quarter basis. Lastly, let's end with some good news where PI Industries reported strong set of numbers. Revenues up 40%, EBITDA up 50%, profits also went up by 43%. It was an all-round beat for PI Industries.
All right, Sonal, thanks a lot for that. So that was a list of all the buzzing stocks and all the buzzing things that took place in trade today, in case you missed out on them. Thanks so much for tuning in to Markets Today. From Prashant, myself and the entire team, it's a wrap. But we leave you with some market opinion coming in from Amish Shah of Bank of America Securities and James Sullivan of JP Morgan. You guys have a good evening.
we have been positive on emerging markets in general, not just India. And if you look at India's valuation premium to the other emerging markets, and India has always traded at a premium, we are currently close to around 45% premium to other emerging markets. At the peak, this number has been up to around 73%, and the average is around 43. So I think we are still very close to the average, which basically means that there is still scope for further re-rating.
This concept that liquidity should absolutely result in higher valuations. And I would challenge that pretty aggressively for the following reason. If you think about the way the math works around a discount equation, to just go very quickly into the math, yes, the risk-free rate is a component of that, but so is future growth expectation. And one of the things that we see going on in markets right now is this argument that lower rates mean higher valuations. The problem with that, theoretically, is it's failing to adjust for these lower long-term growth assumptions. Why are rates low? Because we expect the global economy to grow at slower rates moving forward. So as a result, actually, when you look at the underlying math of the situation, markets should not be trading at higher valuations solely on the basis of lower rates, because we're effectively ignoring the other half of the coin, which is future expected growth rates. Governments have been far more proactive in their approach to addressing the concerns of the average person on the street in the COVID crisis relative to what we saw during the GFC. So you've seen significantly more income support for a broader range of citizens across a broader range of countries. That's helped to create this expectation of a V-shaped recovery. One of the things that we need to be very cognizant of, the economy is recovering quickly on a global basis, largely off the back of absolutely unprecedented size and scale of government support. A large degree of that starts to roll back as we go into 2021. So from a JP Morgan perspective, we are expecting contractionary fiscal and monetary policy as we move into next year. The IT services space is one in India that we remain positive on. The dislocations that we're seeing in terms of government shutdowns impact IT services far less, given a significant ability to work from home so that they're not losing access to their workforce. The complexity of operating environments for all large companies really encourages these IT services firms to have larger contract opportunities moving forward. You also are seeing very clear idiosyncratic opportunities within certain industries. And I point to the telecom industry as an opportunity as people look to move to more of a white box environment for 5G network infrastructure environments. That does offer an opportunity for very significant service integration contracts for the larger IT services firms in India.